Imagine a business where every transaction is tilted in your favor before the customer even walks through the door. In 2025, visitors fed nearly $24.6 billion in wagers through slot machines at MGM properties on the Las Vegas Strip. After the payouts, the operator kept about $2.3 billion. Not because it got lucky, but because the mathematics was designed that way. At first glance, it looks like the perfect money machine. Open the doors, turn on the lights, wait for the crowd, and let every new round work a little bit in your favor. Now travel to the other side of the country. In Atlantic City, a casino called Revel opened inside a massive glass tower overlooking the ocean. It had luxury rooms, expensive restaurants, a huge gaming floor, and a total development cost of roughly $2.4 billion. It was supposed to become the symbol of a new Atlantic City. Instead, less than 1 year after opening, the company filed for bankruptcy. The roulette wheels had not forgotten their mathematics. The slot machines had not suddenly started giving away more than they collected. The casino still held an advantage over its players, and the business still lost. The machines won, the owner lost. So how does a company with a built-in advantage in almost every game manage to lose hundreds of millions of dollars? Today, we are going to buy a casino. Not to spend the night gambling, but to understand who inside this building is actually making the money. And we will discover something every potential owner needs to know. A player is gambling against probability. A casino owner is gambling against fixed expenses. Fixed expenses can be a much more dangerous opponent. Let us say you have the capital, and you have found a casino for sale. Before discussing the price, you need to ask a surprisingly difficult question. What exactly are you buying? Are you buying the building, the land, the gaming license, the brand, or only the company that operates everything and pays rent to the real owner of the walls? A casino may look like one business, but it can contain three completely different assets. The first is the real estate, the land and the resort itself. The second is the operating company, which employs the workers, manages the brand, and runs the daily business. The third is the license that legally permits gambling in that location. Sometimes, all three belong to the same company. Very often they do not. In 2019, MGM sold the Bellagio real estate to a venture associated with Blackstone for $4.25 billion. To an ordinary guest, almost nothing changed. The name remained on the building. MGM continued operating the resort. The fountains kept running, and the casino continued taking bets. But the financial structure had changed completely. MGM was now leasing the property it had previously owned. The initial annual rent was about $245 million. From the street, visitors still saw one Bellagio. Financially, there were now two houses inside the same building. One collected money from guests, the other collected rent from the first. An advertisement saying a casino is available for $1 billion therefore tells you almost nothing. You can buy the operator without the land, own the tower without the gaming rights, or secure a license in a location customers rarely visit. Before calculating the income, you need to know which assets will actually belong to you. An ordinary restaurant can move to another street. An online store can move to another city. A casino is legally attached to its geography. In New York, submitting an application for one of the new casino licenses required a $1 million fee. That money did not buy a license. It bought the right to ask for one. For a successful project, the minimum license fee was $500 million. The minimum required capital investment was another $500 million, and even $1 billion did not remove the need for local approvals, background investigations, zoning decisions, and community support. Location also determines how much gaming revenue the government will take after the doors open. In Nevada, the top state tax rate on gross gaming revenue is 6.75%. In Pennsylvania, the effective rate on slot machine revenue can reach between 48 and 54%. A pair of identical gaming floors can therefore produce completely different results after taxes. A gaming license is both a shield and a trap. It limits the number of competitors, but locks the casino into the rules of a particular state, city, and sometimes a single parcel of land. When you buy a casino, you are not only betting on games, you are betting on regulators, the local economy, and the flow of visitors for years into the future. Now we can examine the part of the business that seems almost flawless: the mathematics. Consider European roulette. The wheel has 37 pockets. 18 are red, 18 are black, and 1 is green. If you place $100 on red, You win in 18 possible outcomes and lose in 19. Over a very large number of spins, every $100 wagered costs the player an average of about $2.70. For the casino, that is an advantage of roughly 2.7%. An American wheel adds a double zero. There are 38 pockets, but the payout remains the same. The casino advantage rises to roughly 5.26%. This does not mean every visitor loses $5 out of every 100. One person can hit a large win and leave immediately. On a particular night, the tables can even finish in the red. The advantage does not reveal itself in one spin, it reveals itself through volume. The more wagers that pass across the tables, the less one person's luck matters, and the closer the total result moves toward the mathematical expectation. The casino does not need to know who will lose tonight. It needs thousands of people to continue playing for long enough. The most valuable resource on a gaming floor is therefore the number of decisions each visitor has time to make. One more bet, one more spin, 5 more minutes. But the house advantage has one limitation. It applies only to money that reaches the game. An empty roulette table does not earn 5.26%. It earns nothing while still consuming wages, electricity, security, and floor space. When people imagine a casino, they picture roulette wheels, card dealers, and a wealthy player in an expensive suit. For an operator, a long row of slot machines may be far more important. In 2025, visitors wagered about $24.6 billion through slot machines at MGM's Las Vegas Strip properties. The operator won approximately $2.3 billion, equal to a hold rate of about 9.4%. That wagering figure does not mean visitors carried $24 billion in cash into the buildings. The same dollar can move from a bet to a payout and then return as another bet many times. The longer it remains in play, the more wagering volume it creates. That is why speed is so valuable. A table game requires a dealer and time for every round. Hundreds of slot machines can accept decisions every second and operate around the clock. A slot machine does more than offer a chance to win. It converts time into a huge number of small mathematical events. The casino has 2 basic tasks: bring a person to a game and prevent that person from ending the session too quickly. The interior, the drinks, the rewards, and the loyalty program all support one of those tasks. Now you begin to notice that the most valuable customers carry a player card. It may look like a discount card, but for the casino, it is a measuring instrument. The system sees which games a person plays, the size of the wagers, the length of each session, and how often that person returns. From this data, the casino estimates the customer's theoretical loss over time. Suppose the mathematics suggests that the casino should earn roughly $1,000 from a customer's typical trip. If that person receives a room, dinner, and show tickets with a retail price of $250, those items are not necessarily gifts. An otherwise empty room and a restaurant meal cost the operator less than their retail prices. By spending part of the expected gaming income, the casino increases the chance that the customer returns and plays for several more hours. A free drink is not a reward for losing. It is an investment in the next wager. But there is a balance. Offer too little, and a valuable customer visits a competitor. Offer too much, and the rewards program begins consuming the house advantage. A modern casino, therefore, manages more than the probabilities inside its games. It also manages the probability that a person will return. At this point, our business is no longer just a room filled with roulette wheels. In 2025, MGM's Las Vegas Strip properties generated approximately $8.44 billion in total revenue. You might expect most of it to come from the gaming floor. Casino revenue represented only about 24%. Hotel rooms generated approximately 34%. Food and beverages produced about 27%. Entertainment, retail, and other operations contributed the remaining 15%. In other words, roughly 3/4 of the revenue did not come directly from gambling. A modern casino resort is better understood as a small city built around a gaming license. The gaming floor creates a unique kind of traffic, and every other part of the building attempts to monetize those visitors in a different way. A guest can pay for a room, dinner, a show, and parking in addition to gambling. Another guest may never place a bet and still become profitable. This can make the business more resilient. A weeknight in the casino can be supported by the hotel, a restaurant, a concert, or a convention. It also makes the business far more complicated. You are simultaneously operating a hotel, restaurants, entertainment venues, security, real estate, and a heavily regulated flow of money. The roulette advantage cannot help if the rooms are empty. Strong hotel occupancy cannot rescue a restaurant with terrible economics. A sold-out show may still be too small to cover the debt attached to the building. A casino can transform one visitor into 5 sources of revenue. It also gains 5 different ways to lose money. Let us say the financial report looks spectacular. In 2025, MGM's Las Vegas Strip properties produced approximately $2.86 billion under a company measure called Adjusted EBITDA. That was a margin of roughly 33.9%. It is an impressive figure. It is not the same as cash the owner can place in a bank account. This measure is calculated before interest on debt, income taxes, depreciation, amortization, and certain rent and corporate expenses. It shows how well the resorts are operating, but not how much remains after paying for the financial structure around them. Return to the Bellagio. After selling the real estate, the operating company continued earning money from guests, but it also received an initial annual rent obligation of approximately $245 million. The slot machines could perform perfectly, and the rent would still arrive on schedule. Now add payroll, security, utilities, renovations, new machines, marketing, customer rewards, insurance, gaming taxes, and interest. Many casino expenses do not fall quickly when visitor numbers decline. An empty hotel tower still requires maintenance. A half-empty gaming floor still needs security. An expensive resort continues aging every day, even when nobody walks through the door. This is where the house advantage meets operating leverage. When revenue rises, much of the additional income can become profit very quickly. When traffic falls, the fixed expenses do not leave with the visitors. A 15% decline in revenue can reduce the final cash result by far more than 15%. A player can stop betting and walk away. An owner cannot stop the rent, payroll, and interest payments just as easily. That is what happened at Revel. The project was supposed to transform Atlantic City. It had a dramatic glass tower beside the ocean, thousands of rooms, expensive restaurants, and a huge resort aimed at a wealthier customer. But it opened at a terrible moment. Atlantic City's gaming revenue had already been falling. New casinos were opening in surrounding states, so residents no longer needed to travel to the ocean just to gamble. Revel depended on one enormous property and one declining market. The company had almost no operating history to prove its strategy could attract the audience it needed. Above all of this was the debt. For 2012, Revel reported negative EBITDA of approximately $111 million. It was unable to service roughly $1.5 billion in debt. On March 25, 2013, less than a year after opening, the company filed for Chapter 11 bankruptcy protection. The restructuring did not solve the fundamental problem. The resort closed in 2014. In April of 2015, real estate that had cost billions to develop was sold for only $82 million. Revel did not collapse because one game was unlucky. It lost to a declining market, regional competition, enormous debt, high fixed expenses, and an unproven strategy that never attracted enough demand. The mathematics on the gaming floor still worked, but it protected only a small percentage of every wager. It never promised enough wagers to support a multi-billion-dollar tower. Now we can build a simplified model of our own casino. The figures are hypothetical, but the proportions resemble a major integrated resort on the Las Vegas Strip. Assume the property generates $1 billion in annual revenue. About $240 million comes from gaming, $340 million from rooms, $270 million from food and beverages, and the final $150 million from other services. In a strong year, the operating margin before rent, interest, taxes, depreciation, amortization, and certain corporate expenses reaches about 34%. That produces $340 million. Now assume rent, interest, and the investment required to keep the resort competitive consume a combined $230 million each year. That leaves $110 million before several remaining taxes and ownership expenses. It looks excellent. Then visitor traffic weakens. Revenue falls by 15%, down to $850 million. Hotel discounts, weaker restaurants, and more expensive marketing reduce the operating margin to 25%. The business now produces about $212.5 million before rent and debt payments. Our hypothetical fixed obligations still require $230 million. The casino still holds an advantage at roulette. The slot machines still retain part of every dollar wagered. The hotel is still receiving guests. But after the fixed payments, the owner has a negative result. We did not need a catastrophe, fraud, or players with impossible luck. All it took was a moderate decline in demand and a smaller operating margin. That is the central risk. A small mathematical advantage can create predictable gaming revenue, while an enormous capital structure can turn a moderate decline into a major financial problem. So, should you buy a casino? First, ask the questions an ordinary player never sees. Do you own the land or lease it? How much revenue comes from gaming? How much will the government take? How long does the license last? How much debt sits on the property? And what happens if visitor traffic falls by only 10 or 15%? A good casino can be an extraordinarily powerful business. It has a regulated barrier against competitors, an enormous volume of transactions, detailed customer data, and a product whose price is built directly into probability. But buying one simply because the house always wins is like buying an airline because ticket prices are higher than the cost of fuel. Between revenue and the owner's money sits the entire machine of the business. A player sits at the table and asks, "What are my odds?" An owner must ask a different question. What remains after paying the players, employees, government, bank, and owner of the real estate? The house advantage can produce predictable income from enough wagers. It cannot guarantee a strong market, affordable rent, responsible debt, or profit for the owner. The house usually wins. But sometimes the real house is the bank, the government, or the landlord. So before you buy a casino, make sure you are not simply renting a room inside theirs.